Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is FOMC Live. Today, we're going to be covering the big-time event out of the Federal Reserve. We're going to be talking about their latest interest rate decision. We're also going to be talking a little bit about why Jerome Powell is going to be an interesting fellow today at these announcements, and we're going to dive into all of it. I'll take all of your questions. We're getting an early start right now because there's no time like the present. There's no point of sitting around and waiting, and we can just get on with it right now. We had a trade idea out earlier today in the Euro USD. I'm going to cover that one in a minute. I think we're going to have an opportunity to make a little bit of money, though, today. I really like what's going on in the silver market. You've got a big-time rally in silver, almost another percent. We had a great 9 EMA trade that just hit the news wires about, 20 minutes ago. Real short time frame, but I loved it. We're going to show you that. We're also going to do a little high-impact scalping today. I think we're going to go ahead. We're going to select a potential market, a good target market, and we're going to go ahead and throw that on the 9 EMA strategy, and we're going to probably execute some trades there over there on your MT5 platform. A lot of us don't typically do that, but we're going to go ahead and see if we can get some going. So another prediction smashed with gold. Did you guys enjoy the $5,250 level? It was absolutely crazy. I mean, we called that. I watched it last night as it happened. It was one of those events that I sat there and I just watched the thing go to the moon, and I said, yeah, that's a pretty good trade. That's a pretty good trade. Andrea Garwell, good to see you over there in the How to Trade community. Tuku, welcome. Gordon Williams, can you look at the Euro USD? It gapped higher. I'm not sure I see the gap higher, Gordon, but what I will do is pull up the short price frame. We were looking right at that 118.90 level. I put a trade idea out earlier today, and sort of read them and weep. Right here was the nice action we were looking for on the United States Federal Reserve, making their written statement telling us that they're keeping interest rates static for now. But boy, that economy's improving, and I don't buy any of it. I think that we're in for a heck of a year. I think Jay Powell's going to be combative today. I'm interested to see how Jay looks, if he's a little bit more tired. I mean, being under DOJ investigation's tough. We've also got a big story. We got to cover that before the announcements, before we get into that press conference. So Euro USD 119.13 is the print right now. We were hanging out down there right around 118.91ish, and you can see this low, really a beautiful thing right there at 118.95, and now the bounce. So for me, still watching that level closely, that 118.90ish. I think that's a big time zone, and where we derived it from was just a basic Fibonacci retracement weekly sequence. We weren't really interested in trying to reinvent the wheel here. I'm not going to go, okay, we're going to Ichimoku candles or clouds or Takenashis or any of that stuff. I have got more questions about Japanese technical analysis over the past 3 days than I have in the past 5 years of being on these live streams. But I will say this, I don't have any expertise in Haikanashi. I don't have any expertise in Ichimoku clouds. I don't even know how to play Sundoku puzzles. I don't know anything about it. So when you start asking me those questions, I'm going to disqualify myself right off the jump. There's no way that I just don't know the answers, but I do know Fibonacci's, and we have a pretty good grasp on key levels and also what drives these markets. We're in a pretty good position now, really, as we wrap up January. Might put together a performance metric of how these ideas have done. I don't know that I want to do that, though, because I am not a signal provider. We got to get that straight. I don't provide signals, but man, maybe I should go into business. This last month has been absolutely on fire, and it's because of the volatility in the market. Let's be honest. I mean, we're getting great story after great story. You know, folks that are excited about the silver run, that got in on the silver run. I'm getting good. I got some great feedback the other day. A gentleman that was trading the 9 EMA, which was a strategy that was very popular. We put that out on how to trade about a year ago, and said he's been just killing it in his funded account with it. So, you know, to me, I look at strategies like that, I go right on. So what is it? Is it a factor of everything's working? Are the strategies that's that brilliant? Are the market calls that good? Or is it time to trade? Is it time to trade? That's what it's about. Right now, 2026, this is going to be probably the biggest trading year. It could be of my career. It really could be. We see the potential for some big moves, and I love big moves because the beauty about big moves is, man, when you get in on them, you get a lot of money, and that's what it's all about, guys, is trying to make a little bit of cash, and I think that we're going to have a real opportunity this year to do just that. So, welcome. I got a lot of folks in the room. I'm going to take a few questions, but we're going to go ahead and run through some levels, and also we've got to cover some news. And remember, if you want to trade anything that we talk about today, head on over to Switch Markets. Bring your ambition into focus. Thousands of global markets, tight spreads. One thing that I did want to talk about, though, is margins. There's been a lot of folks reaching out to Switch Markets support about their margins. And the margins right now have been increased. They've been increased, but listen, it's been increased all across the board. I've got, 5 or 6 emails from my futures brokers here in the States. They've jacked up the margins. The reason why they've jacked up the margins is because the market is absolutely crazy. So remember, the broker reserves the right to adjust margins to whatever they see fit given current market conditions. That's absolutely imperative that you understand that. And it's not necessarily just to protect the broker. I mean, a lot of it is, but it's also to protect you. You got to remember that you're not just liable for what you deposit into your account. If you take a position and you're caught the wrong way and they come back and say, okay, you're 50 grand in the hole, it's on you to make it up. And you say, what are you talking about? I only had 5,000 in my account. Well, it swept against you and you got blown out, what we call blown out of the box. You got blown out. So you want to make damn sure that you're ready for that stuff, that you understand what a margin requirement is and why exactly it's important and why they're increased. It's not just to protect the brokers. It's to protect you too. So I look at it and I say, okay, well, do I want to be even trading in this environment? Well, I mean, margins have gone up across the board. They've doubled my intraday margins on gold and silver. They've doubled them on my futures accounts. You've seen over at Switch, I believe the margin on silver has gone from 0.2% all the way to 2%, I believe. Don't quote me exactly on that because those are changing a lot. But you've been in contact with your broker, you know. So they have definitely lifted those margin requirements north, and that's absolutely big. That's absolutely big. It's not just for them, it's for you too. So be aware of that. Be ready. When you see margins get moved, or maybe they freeze trading, well, you've got to have an understanding of what's happening. Essentially, things are crazy. And when they're crazy, you got to watch yourself because you can be on the hook for a lot of money. Now, today, Fed statement, crazy metals markets. I'm sure Trump's already out talking about something, about somewhere, something. But what we can say is this. We do know that the Fed kept interest rates static. We know exactly how exactly that's going to impact. That's how exactly that's going to impact everything. We know that it's all about tone. We know Jay Powell is up against it. He's up against it, and there's no two ways about that. I'm definitely interested in what he has to say today, more so than I usually am. So we're definitely going to make an effort, potentially, to understand where Jay's coming from today. This is going to be a good one, though. I mean, I can't wait to watch him fight it out with the media, definitely. So, Euro USD is definitely on the chart, 118.90. Here was a pretty good trade just a little while ago. This was in silver. Good-looking minute one chart, 1 minute silver chart. This is our basic 9 EMA strategy, right? Right there, you're in oversold territory on your RSI, right down there, right around 27. You can see that little hammer formation. There was your buy. I actually executed this one a little while ago and watched it run, and this was just an absolute. I mean, that's one of those that you can make a lot of money, especially if you're trading full lots on silver right now. You need a lot of money to make that trade. Really a beautiful trade, though, right ahead of the Fed. There's the Fed disturbance. That's what it did to the market. Extreme chop, and then we've continued the march upward. Looks to me like 125 is going to be what's in store for silver very, very soon. That's for sure. It's good to see everybody out there. Yes, sir. What a beautiful day. Caught an awesome buy on gold in the Asian session. That'll make you smile. Tina Jing. Hi, Shane. Hi, Tina. How are you? I'm doing very well. It's good to see you back. Ice Hazy. Another prediction smash with gold. Yeah, we got it. But the swings and liquidation bars were crazy. Absolutely. Tina, it's scary. It is scary out there. Where's the trade? Earnings. Earning lack. Yeah, we're going to be doing all sorts of trading here in a minute. There was a big drop in the UK afternoon. Big time pullbacks. Volatility is definitely what we're looking at. So let's go ahead and drop our gold here. 30-minute chart. I mean, you can see right there. Really choppy price action. Then we sort of moved forward, and then there was sort of the precursor to your Fed announcements today, and now we're just sort of moving sideways. 30-minute chart on gold. Pretty big chart to be playing right now. Pretty big. So we're looking at a 5-minute chart maybe. Let's take this down to a 1 minute. Do we have an opportunity potentially to sell this according to the 9 EMA? If you guys aren't hip to the 9 EMA, we're going to have a new video coming out here relatively soon. That's going to be beamed out, I think, everywhere, I don't know, in the next week or two. But this essentially is the trade. We already have one up on how to trade. Nice sort of swing to high there. There's your close beneath the price bar, and now you're coming down a little bit. The only thing that qualifies this trade is it was not outside of that or in overbought territory on that RSI. So that right there probably wouldn't have been a trade that we were going to execute. Let's see. Earnings. Gold, buy or sell. Let's wait a minute, earning, before we start buying and selling really anything. We've got to be very careful about what happens today. Charles just joined from Zambia. Good to see you, Charles. Welcome from Zambia. I've never been. Want to get to the price pullback to Euro USD for the long. Yeah, I mean, we're really looking right there. 118.90. I believe the entry point I put out earlier today was a 91. But realistically, you know, you could keep it on. You could pull it. The low right there was 95, and we already got a big bounce. But that zone right there is a pretty good one. That's for sure. What's my thought on tomorrow's news? The news is coming now, Klaus. The news is coming right now, so we got to be careful with what we do. I'm planning on funding my account. What's your advice on lot size? Well, I mean, it's, 1 to 3% of your total trade. We do have a risk management EA that you can definitely check out. We also have a lot size calculator that you can check out on over at Switz. Let's go ahead. I'll show you a few of these tools real quick before we get involved with what we're doing. Okay, switch markets. You're going to go right here, and you're going to go up there. There's a little drop-down menu in that right. You're going to go right there to Tools. Click on Tools, View All Trading Tools. Let's do it. The one that would really work for you is going to be your lot size calculator. So essentially, you give that a click, you pull it up, the instrument you're trading, your deposit currency, your entry level, your stop, your risk tolerance, your percentage, and your account balance is going to give you exactly your desired lot size. So the key for you in this risk tolerance or risk percentage, you're going to be looking for about 1 to 3%. So I would go ahead and assign percentage and be looking for anywhere from 1 to 3% of your total account balance, and that will calculate, and it will give you an exact lot size that you also that you can employ right there in the market. Now, as far as we had one other thing we wanted to talk about, and it's an EA. Let's go right over here to the resources. There's so many free tools in here that you guys can use over at Switch. Expert Advisor EA tools for all traders. Support and resistance, live currency strength meter, value at risk. Risk management EA. This is a good one. You can download this. You can dial in your exact position size, your lot size with your account balance. Also, it helps you align your risk to reward, your stop loss, and your profit target in the middle of a trade or right as you take it. That's a pretty good one, that risk management EA. Keep a close eye on that one if you have any questions at all about your lot size. That's for sure. Let me see. Tina, did you say, though, 1890.01? Yeah, 1891 to 1892, somewhere in there. Oh, we're actually coming up on it. We're about 14 pips off in that Euro USD. Let me see. T Marino, OMG, the spread for silver was more than silver. The spread's huge, isn't it? It's big spreads. That's why the margins are low. Excuse me, let me rephrase. Big spreads, that's why the margins are high. That's for sure. Lewis, good to see you, Lewis. Welcome. Robso, hello, the news. Yep, we're going to go ahead and cover the news here. Steve Francis, good to see you. Bobby Bob. Gordon Williams, white shirt. Yeah, that's a black tie event, isn't it? I'm hanging out with the best people. It's a black tie event. Why not? I'll get dressed up for the Fed. Jay Powell, he's going to maybe he doesn't wear a purple tie. Maybe he wears a blue tie for the Democrats today. Who knows what he's going to do? Lita, good to see you. Lita, Ralph H. Tuku. All right, guys, let's go ahead and see about a few of our key levels here over on our Trading View. All right, Euro USD, I think we're dialed in there. U.S. oil, this is a trade idea that I put out earlier today. It was a pretty good one. Depended on your broker if you got filled or not, but right now our high is right at 63.52, and we're pushing higher just a little bit. We showed a surprise draw on crude oil inventories today, which is sort of interesting considering where we're at this time of year. Should have been a build, it's a draw, and that has brought a little bit of bullish participation to the markets. So we definitely want to be interested in what happens right around that 63.60 level. Pretty good trade though. If you got filled at I believe it was 63.55. Somewhere in there, 57. If you got filled on that, you already got paid. But this right here should be an intermediate term top. I'm looking for a little swing high to develop and maybe give us a pretty good position short going into the late week. I would love that for U.S. oil. I think that's great. U.S. dollar index, the DXY, sort of rebounded today. Pretty good day, up about 1%. We're expecting maybe a little bit more hawkish sentiment out of Jay Powell. I don't know that we get it, but it's been just a brutal week. You can see we had a sell signal actually develop last Friday, and then there's the big sell-off, and here's some rotation coming our way today. So I'm watching that relatively closely. I think that this could be one of those trades where we get a bounce out of the USD and an opportunity to play some of those majors off of some key retracement levels. Remember, markets don't move in straight lines. They don't move in straight lines, and this is just a sort of a typical pullback. I'm a big proponent of a bearish U.S. dollar. I don't really see any way around that for this calendar year. Silver, everybody's talking silver. There it is. Key level at the top side is 125. I think we're going to see that probably sooner rather than later. The trajectory is definitely to the top. Your high right there is 117.75. Keep a close eye on that. You're going to want to make sure that you're dialed in and ready to rock there. When we get there, don't short. I can't tell you what to do, but be careful shorting. If you're holding short positions in metals, you are tough. And you are braver than I am. That is scary. I don't get scared by much. Honestly, not too many things. That scares me. Holding shorts in the metals markets right now scares me. Gold, 52.93. You can see exactly where we're at. We had really a great call. We talked about that top side target of about 52.50. Let's go ahead and just dial this in correctly. But 52.50 was one of those levels that I said, listen, you got a real good chance of hitting this soon. And we did. You can see there was just sort of your top right up there. Your high was 52.47. Nice pullback down to 52.24. Those are huge, huge size 5-minute or 30-minute price bars for that time of day. Realistically, that was sort of in early U.S. session, or excuse me, early Asia session. Really, really huge price bars. Then you got that bullish pennant, and then a breakup over 52.50 pullbacks. And I mean, if you're looking for potentially maybe a bidding area. During this engagement, maybe 52.50 is the one. Maybe the 52.50 is the one. That's for sure. As far as what I'm looking at, pullback buys. We got our 920 EMA crossover sort of dialed up there, but pullback buys are going to be the way to go with gold. This was a sort of a system that I was working on the other day. I wanted to show this because you can see today, absolutely dreadful performance today, and this was a long-term winner. You can't really see it. That's behind my head. You're down about like 8,000 playing this 5-minute signal today. If you are interested in systems trading, get used to that. Get used to that. That's how it is. It really is. You get up days and down days, and you can see got a couple of losers there, and then you took a huge loser on that right there, and the market bounced up against you. Really ugly stuff. That's systems trading. All right, let's go ahead and take a look at something we can scalp and sink our teeth into. Jay Powell is the man of the day. He's coming out momentarily. Let me go ahead and get us dialed up. I believe that, yep, here it comes. Let's go ahead and click on this desktop audio, and then we'll go right over. There it is. So there's Jay. I believe that's where we're looking. We're going to be looking at gold right here.
Good afternoon.
On a 1-minute time frame.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we've lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that you attended the Supreme Court hearing last week on the Lisa
First
Cook
question.
case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought
Little 1 minute
it
buy.
might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply
he's got to read it.
It used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
It's all about politics.
Today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas. But I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
There you have it. No comment. No comment about the most important thing in the room.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is?
He's not going to tell you
and
that.
If not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
0 for 3. He won't answer anything.
Want to leave it all under the circumstances?
Again. I don't want to get into this. It's not something I'm. There's a time and place for these questions, and
right now,
but not something I'm going to be getting into today. Thank you.
Really choppy conditions across all markets. We've got a 920 crossover there. We'll see if it moves higher on gold, but I'm not convinced.
And another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the U.S. currency lower?
Good question.
And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency, and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But, what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't.
Man, he's not answering anything. 4 questions, 4. I don't have anything.
It's just not appropriate.
He's
for us
taking
to
the
do. So
fifth
really
up
the
there.
Treasury Department has that. It's their role.
You gonna answer a question?
And we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting, we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
Universal.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
It's the same answer every single time. We're data dependent. I mean, look at how choppy the market is
Steve
right
Leisman,
now.
CNBC, and sticking with questions you might answer.
I mean, I'm waiting
Thank
for a
you.
big sweep either way in gold, a big one.
You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the S&P and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. I mean, maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range. But so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. Is that, you got to follow up?
I get what you're saying, but some officials
Nobody
have
gets what
described
he's
the Fed being
saying,
in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, the Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
We're going to let the data speak to us. This guy's unbelievable.
Mara Moakley from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks have probably both diminished a bit. So we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
Will you? He hasn't answered anything yet. Not once.
Thank you, Mr.
Nothing.
Chairman. Edward Lawrence from Fox
Nothing.
Business. Has the effects of tariffs already moved through the economy on prices?
Good question. Simple one.
A lot of it has. So basically,
Kinda.
there are many different estimates, and
Many
they're
different
all
estimates.
highly uncertain, but most
Pick
of
one.
the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything. That will depend on.
I don't know. I don't know. You don't know anything, Jay. These are worthless. They ought to call it off right now. He hasn't answered anything.
Thank you for
0 for 5. 0 for 5.
Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy is in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate. That the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting.
Pretty good illustration of what it is to scalp the 920.
Have remained in places that are very consistent with 2%.
Sell signal. We lost. Cut off the loser.
Have been solid, and they reflect confidence.
Buy
in
signal.
Return to 2% inflation.
Boom. Buy signal.
Andrew.
You hung in there for a winner. If you moved your stop loss to break even, you got stopped out at break even. That's a great example of what it is to scalp during these types of periods. Let's find a better trade.
The market was greater than the risk to the inflation side. Is that still true?
We haven't made
E-mini NASDAQ futures.
We saw the labor market weakening, and we acted. And I think that's the appropriate thing to do. We will always act to address what we see.
Look how
as,
choppy this is.
The economy moving away from our
Horrible.
goals.
Horrible.
Risks to both of the variables are a little less. I think that the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less.
Look at this.
I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks
could maybe buy a pullback.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse,
this is interesting.
you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments too on inflation, though.
And if inflation does pick back up and the labor
Market's
market
not
doesn't show
trending
further
at
signs
all.
of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table,
Buy
but it isn't
signal.
anybody's base case right now.
Pull back,
Anybody's
US
base
100
case
and
that the next
E-mini
move
NASDAQ.
will be a rate hike, but ultimately
It's really
we'll
choppy.
We'll do what we think is the right thing, but that's not where people's expectations are right now.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot.
Great Britain
because
pound
of what's been happening
USD.
in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment, and so the fiscal picture needs
This
to
could
be
be a pretty
addressed,
tight scalp.
and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up.
Crossover,
in some kind of a
bid.
difficult thing, but that's not where we
About
are.
a
It's not what
1-to-1,
Japan
very
is either.
tight, right beneath
But,
the signal
certainly
bar.
not where we are right now.
Does
Not
it
a bad
reduce
trade.
The effect of
It's
your
it's
rate
cheap.
cuts
It's
that
affordable.
longer-term rates have overall not really budged that much?
5-minute
I wouldn't say
duration.
that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile.
Yeah,
So
you did
this
it
isn't-
in
I'm not talking
September
about
of
the US context.
2024.
This is every advanced
You know
economy
you did.
democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it, and we haven't lost it. I don't believe we will. I certainly hope we won't.
You
But
guys
it's
have
very
lost
important,
faith,
and the reason
believe
it's
me.
important is that
Believe
it's
me.
enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Well, we talk about who the shareholders of the central banks around the world are. That's what the conversation really is, Jay.
Archie Hall from The
Who are the
Economist.
shareholders?
On that sort of
It's not the people.
stabilization of the labour market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Nice little move. Dollar's starting to
Part of
fade.
it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially the economy has once again surprised us with its strength, not for the first time. And consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from.
Yeah, we gotta talk AI. Got to get that in there.
Growth is on a solid footing, it looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated
right there's
inflation.
A banger.
But you
Pull
talked
back
about
trade,
those customer
5
survey,
minute,
or
boom.
those consumer
Very
sentiment
nice.
surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues
That's very nice.
about
Good stuff right
how
there.
wealthier
consumers seem to be driving so much of the economy, and why so
Beauty of
many
that is you can
families
just scalp
still
that.
feel
Got a
like
nice little bump off
they
of
just can't make ends
62%.
meet after 5 years.
You take
of
the money
rising
and run or
prices.
let
What
it
is
bleed,
that
whatever you want to
discussion
do.
So a couple things. One,
That type of
there's
thing right
something-
there.
Something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability. And so, the best thing we can do for
where the hell have you guys been?
That squeeze is to keep inflation under control, and frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment, and trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time, is rising productivity. So and we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Thank you, Chair Powell. Beyi from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that
how do you build
most
this
of the overshoot was in goods prices, which we think is related to tariffs. And ultimately, we think those will not result in inflation as opposed to
You have
a one-time
options.
price increase. Okay, so
Stop loss could be
that's-
very
that's
tight right
where
there.
it is. In terms of, you asked,
Could let it bleed like that. It's a pretty
no one
big
thinks
trade.
They will.
Let's play real tight right here, real tight
ex ante
scalp. See if we can
understand
maybe
really clearly
rack one more winner.
precisely when this will happen.
Maybe something
But
right
there's
like
an
that.
expectation that sometime in the middle quarters of the year,
It's tough playing this
we'll
tight.
see,
Let's go ahead and put it
tariff
beneath
inflation
our
topping
averages,
out.
right down in
so
there
what we
somewhere.
do is when a tariff is put in place,
Take a shot.
we track the effect of those tariffs
Something like that.
over a 6, 7, 8, 9
Tough
month
trade to
period,
get,
and you
Bobby.
can see-
US 30 is
and
very
you can
choppy.
see
Very,
for
very
that
choppy.
tariff how long it takes to reach a place where
it's either gonna break in
affected
our
the price
favor or it's
level, and
not.
That's it. So we're
Not the
getting
best
better
trade
at
in the
that,
world.
And our estimate is that
Still,
it'll
though,
be
you have a
sometime in
signal.
the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether
RSI
things are
right
moving
around
that direction.
50.
I think
So you're playing a
we'll be able to
breakout,
see.
essentially.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week
Tough trade,
that there's
though.
been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So
Tight spread, though.
I can't comment on that speech or statement or anything like that. Geopolitical risk.
What can
for
you
us
comment
is-
on?
A lot of it is around energy, oil, and so far we haven't. For all the turmoil, oil prices have come down. As
Oh, there you
know,
go.
and so we don't
There's your
really see
breakout.
much.
Compression, break.
Longer than that, it's trade, and the
920's on
trade,
fire today.
our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
So you were wrong about the tariffs, then, weren't you, Jay? 100% wrong.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
It's a great. It is the question.
We didn't cut rates today, but
oh God,
it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year, so the overall over the year the numbers were nothing like that. It was more in the mid 2s for the year.
And how do you explain the divide right now
rotation.
between strong economic growth
US
and the
30's
job
tough.
market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
Take a look at Euro USD.
There has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by
Maybe a Fibonacci scalp?
rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is
5-minute
that when
range.
GDP and the
Good
labor
observation,
market get into
Gordon.
an argument,
Good move.
in the end, labor market is
Pull
more
back
the labor
by.
market data is more reliable.
See if we
GDP
get it.
data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence,
soon?
though.
Matt,
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Well, another is
but you did it.
That our window into democratic accountability is Congress, and it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers, and so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Cadre, interesting choice
Thanks
of
for that
words.
answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late, and I'm wondering how much attention, if any, you pay to those moves, and what
We'll
message
comment on the markets.
you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be.
That's
so
not
we look
true.
at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
All right. The last question. Make it a good one, Nicole.
Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model, and we knew it from the very beginning.
Sweep low
it
or
was not
out.
in the model.
Euro
a
USD
trade war
reverses.
of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here, and like maybe happening now with AI, we're all over that. And everyone studies those periods, and we're very clear-eyed about the possibility that this higher productivity may persist, and also that it may not. We're not. No one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling. and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. You know, the trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time?
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything, and so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data, and you know our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
Well, there you have it. The latest from the United States Federal Reserve, Chairman Jerome Powell. Lots of questions. Let's see. One from 512 Eli. Rising productivity will be measured by AI innovation. I wonder how that will look. Well, rising productivity with AI via AI means less workers, less employment. No question about it. Unemployment will go up. There's no way around that. It's no different. I mean, honestly, just think of a real world example of something that's happened in my lifetime is all the old assembly lines that they had in Detroit making all the cars for GM and all those companies. Now, there was a lot of reason they went out of business, but one of the things that really hurt the employment situation before you saw really the globalization of that industry via NAFTA and trade deals back in the early 90s was automation. All of a sudden, they didn't have to pay somebody $50 an hour in benefits and insurance to put a tire on a car. It was all done by the machines. This is the same thing. Believe me, when we talk AI, I was a writer for years. Before I ever started on the live streams or doing this, I was a financial writer. And what I did back then is obsolete now. You don't need it. You have AI. It can go through. It can do all the research, structure all the pros, and do all the work that I could do. And it can do it faster. And in some cases better, but not, I mean, you're still going to need rational folks to guide the AI. So the AI serves our purposes. But big picture, just it made the writing into the game. Pretty much everything, not everything you read. My daily trade ideas, I write those myself, but pretty much everything you read is AI. It's all AI. Something to think about there. So, what does the productivity look like? You'll know AI productivity is booming when the unemployment rate goes up to about 10%. And that's just the honest to goodness truth. That's why we're sitting here going through these markets, seeing if we could develop methods of making a little bit of money. All right, let's do a quick recap, and then I got a couple things we'll hit, and then we'll go ahead and sign off. We've been on long enough today. As far as what we had here, this Euro USD, nice little scalp, 38% swept us out, and now it's rebounding. That's okay. I don't mind taking that loss. It was a very small one. Wanted to get this entry down here, though, on the 5-minute time frame, 129.28, somewhere down there. I would have loved to have bought those quarter handles and maybe look to get a few pips on the comeback. It doesn't look like we're going to get that, but you may later in the day. Personally, I'd probably shut it down. As far as the rest of our trades, they actually went pretty good. I mean, if you just want to look at the balance history, we started off with a massive loser. We traded the 920 EMA crossover strategy pretty well. This right here was a pretty good loser right off the bat on gold, and then we switched. You'll notice that's one of the benefits right there. That's a real world benefit of using larger risk versus rewards. The second one, I really didn't have a problem putting it on for like a 1 to 2 risk versus reward because the pressure's up in metals. We're looking for any reason to buy. And probably the smart thing to do would have been to pass on the sell. But in any case, we took the buy. We hit that one. As far as this NASDAQ, E-mini NASDAQ was also a 5-minute 920 trade. Waited for the pullback and just hit that real tight scalp. That's a more advanced way of trading. The bottom line is I had a stop out point. I knew exactly when I was going to get out, but I also knew if the market jammed in my favor, a few $100 within a few seconds, take it and move on. Didn't have a problem with that. Remember, these are demo dollars as well. I really like that Great Britain pound USD setup, though. That was a good one. That was a trade that you could actually sink your teeth into. You had a nice stop loss. You had a nice profit target. The thing just went up there and got its points. That was fantastic. This one right here, the US 30 1-minute trade, that was really a compression play. The RSI was right at 50. We saw the bars loading up. That was extremely risky. And once again, these are demo dollars. These aren't real position sizes, but you probably could have put them on maybe on a prop account. That was probably the riskiest thing we did today right there was that US 30 trade just because the market is absolutely flat. Yeah, we won, though. Then right there, you can see that last trade, the Fibonacci pullback trade on the Euro USD stopped us out. I'm not real happy about that, but it doesn't surprise me with forex pairs. I was told by an old forex trader once, Shane, you need to look at 50%. You need to look at 50%, especially for the Euro. And I said, yeah, and it really is. I mean, there it is. Pulls back to 50%. Bounces. So a huge contract like a Euro USD, 50% is a big deal. I don't like trading it. I don't like getting out of my game for any reason, right? For any reason. One last thing, or actually I started off the live stream showing you this. This is something I've been kicking around and toying with, and I want everybody to understand really what this stuff is, and it's the future. You're coding things, you're getting ideas, you're coding strategies here. On TradingView, you can see exactly what's happening. And essentially, the ebbs and the flows of the strategy, it's very, very important that you understand that you could have a strategy that is extremely profitable. Extremely. This one right here, we'll just dial it back to the last 90 days and run the report. And you can see that you've got a pretty good profitability curve. That's pretty much what everybody looks at. And then today, you got the big fall off where would you have 3 losers in a row, which is rare for this strategy. But you could see you could have a really successful strategy, but one day can absolutely sink you. That's one of the reasons why I don't really trade Fed days. Is that the reason why this thing's losing today? You'd have to factor it. I would look at the past 5 or so Fed days and see if it always loses. But what I mean is if you're going to be a systems trader and an algo trader, you've got to study your losses. You've got to look at your worst losing days. You've got to see how many trades in a row you should lose because managing a system isn't much different than managing a trade. When you manage a trade, the question is always, am I in or am I out? Do I hold or do I fold? That's the bottom line. And with your system, it's going to be the same thing. It's going to be the same set of questions. Do I let this thing run? Do I cut it off? Do I make changes? Do I scrap it completely and go build a new one? Those are always going to be the questions in your mind. And the only way that you're going to know it without losing all your money is be monitoring the performance and saying, okay, how many trades over my back-tested data do I typically lose in a row? What would be considered an outlier? And if you look through 3 years of data or 90 days of data, whatever you're doing, you say, okay, I've never lost 2 in a row. And then you lose 2 in a row, you need to step back and say, okay, what happened? Another thing, a news day like today, a Fed day. Traditionally incredibly difficult to trade. I've taken big hits on Fed days. I don't trade them anymore. Maybe that'll change. We do have a couple more 920 EMAs like this. Maybe I'll just trade the 920. My point is this. If you're always getting crushed on Fed day, don't trade Fed day. I mean, it is easy. If you're a pitcher and they're always hitting your fastball out of the park, start throwing some curveballs. I mean, that's the bottom line. So we always have to be ready to adapt. I don't care if you're a systems trader, an algo trader, or a discretionary trader. Evaluate your performance according to your losses. If your losses are huge, you need to figure out why. If you're not losing very often, but you're still losing money, those losses are huge. Figure out why. Maybe you're always taking a big loss on a Fed day. Don't trade Fed day. It was similar to what we talked about the other day. It's like, Shane, every time my stop loss gets hit, things reverse and it goes in my favor. I go, okay, that's easy. Put your entry point where your stop loss should be. Done. I keep back testing and I get these incredibly losing systems. I can't get a winning system. Wait a minute. Your system is a loser, proven loser? Oh, yeah, I'm losing. I'm only winning 30% of the time, and I guaranteed I lose. Oh, every day I lose. I go, great. You have a great system. Switch your parameters. Enter where you exit. Exit where you enter. I'm very, very serious, guys. Some of the best things in this world have been found on accident. You know, not to be a cliche police, but penicillin they found on accident. It was growing on a cheese sandwich. Somebody took it and said, wow, I feel better. That's what we're talking about. I don't care how you get there. Just get there. Every time I get stopped out, the market bounces. Easy. Put your entry point where your stop loss is. Give it a go. Remember, there are no rules. Don't get caught into one way of thinking. Stay fluid. Be on your toes. Have the ability to think long and short all at once. Like I say, you know, for a trader, you have to be able to hold on tight and let go at the same time. Work on that. Be fluid with your thinking. Don't just get into these things and go, the market's going down, down, down. I can feel it. Okay, great. If it doesn't go down, you're going to lose. I've been harping over and over and over again about the dovish dollar and what's coming this year. I'm going to know very, very soon after they get a new Fed chair in if I'm right or not. And if I'm wrong, and all of a sudden that Federal Reserve's taking a hawkish tone, I'm going to say, okay, I have to reevaluate everything. But until then, I feel like we're in pretty good shape. Always evaluate your losses. You learn from losing. Evaluate your losses. All right, two quick things we need to cover before we sign off here, fundamental wise. This is what I'm watching right here, and this is why I believe there's going to be some real opportunities trading against the dollar later this year. So this is our CME Fed Watch Index. Today they chose to hold them steady. This is the December. I'm always thinking about where we're going to land at the end of the year. Where are we going to land? And the market's right here, 33.29. Okay, so basically they're saying probably 2 rate cuts. 2 quarter-point rate cuts are about it. Interesting. That's what the market's really pricing in. Sort of this is the middle of the road right in here, maybe 3 rate cuts. And then right down in here is sort of where I'm thinking that we're headed, right in this area. Probably one of those 3, 2.5 down to 2. If I was betting right now today, that would be what I would bet on. The odds are not good that we go that low. Right now, the markets don't believe that we're going to get those kind of rate cuts. And then I see headlines like this. Fed keeps interest rates unchanged as Trump promises big cuts with the new chair pick. So the question is who are they going to bring in and how are they going to make them cut interest rates dramatically? Because big rate cuts don't mean this. They mean this down in here. Are those going to materialize? Maybe. Can Trump really have that much say over it? It's going to have a lot of say over it. It's going to nominate the next Fed chair, and they're going to be an incredible dove. That's big. Last thing we're going to talk about with Jay Powell is the Jay Powell investigation, the background of the investigation. Basically, what's happened is you've got a DOJ investigation. They're handing out subpoenas. I do believe that Jay Powell's going to have to testify in front of Congress. I think they're talking June after his tenure's up. Essentially, what the problem is the cost overruns on the Fed chair, on the Fed headquarters, and they're not just little cost overruns; they're big. They're, I believe. Don't hold me to the exact numbers. We look at 1 million numbers a day, but $2 billion. I think the $2 billion is a cost overrun or something crazy like that. And they're running on about a decade of this project, and the thing's still not done. So what we call in the United States, what we call something like that's called a big dig. And what a big dig is, it's like the bridge to nowhere. It's like Massachusetts had a great one where they were trying to build a tunnel, an underwater tunnel, and the thing never got built, and they dumped like $2 billion. Probably the biggest one of all time that still goes on today is the high-speed rail in California. They're like $100 billion into that or something crazy over the last 15 years or 20 years, and they haven't laid a foot of track. They're still in the planning stage. We call those big digs. And what a big dig is it's a place where you can just spend a ton of taxpayer dollars and everybody gets greased. That's what it is. So is the Fed headquarters a big dig? Yeah, it is. It's over. They haven't got it done. It's constantly cost overruns. And the problem that Jay Powell's going to have is it isn't necessarily his fault. I mean, the project was ongoing before he got there. But his testimony last summer in front of Congress, they asked him about some of the more lavish things that are going on in that building, in that construction, things like gardens on the roof, things like, the old axiom was golden toilets and crazy things like that. Well, he said there was none of that going on, and it turns out they went to the job site and they looked and they said, this is incredibly lavish. So they've got a case against him for perjury, and he knows that. And that's why he didn't say anything about the court proceedings when asked on it today, because probably his attorneys told him not to talk. So that's another thing hanging over the Fed's head. So when Jerome Powell sits there and he says, we have credibility, no, you don't. No, you don't. And I have proof. $5,300 gold. That means that not only are investors not believing in the U.S. dollar, they don't believe you guys can stop inflation, and they believe it's going to get worse. That's what we call prima facie evidence. Evidence on the face. Look at the gold price. You sit there and you listen to Jay Powell skirt every single question. He avoided every single question today. Data dependent. We're going to let the data guide us. We're going to let the data guide us. Well, that's not what you're supposed to be doing. We had a great comment in the live chat here on YouTube. It was, aren't you guys scientists? Aren't you supposed to be measuring things and making decisions? Not let the data guide us, the magic 8-ball. He gets out his magic 8-ball. And my point is this. The Fed doesn't know what to do. And the next folks that come in are going to take the reins. They're going to be diplomatic about it, but the marching orders are going to be cut interest rates at all costs and do it dramatically. And the idea behind that is going to be prop up economic growth at all costs, promote maximum employment, even though inflation is going to be persistent and entrenched. The idea is that the workers are going to be making a little more for their money, they're going to be making a little more money, and that'll offset the cost of a $25,000 or $25 steak at the store. Not $1,000, we're not there yet. See Japan's economy, the Japanese yen. That's the case study for this. Go back, take a look at 2012. Take a look at Abenomics. It's almost the same template, what Trump's talking about and the administration's talking about. Do I think it'll work? I have no idea. We do know this. You're not going to be able to control prices going down this road. You're not. And people are either going to be able to live with higher prices or they're not. We'll see. One last thing with regards to the discussion over tariffs. Pretty much everybody was wrong about the impact of tariffs. We saw that today. Powell basically said, well, the tariffs are a one-off in the goods, and then he comes back in the next sentence and says, well, the importers and some of the producers are eating those costs. So what is it? Is tariffs the reason for all the high prices? Is that the reason? Because if that's the reason behind the high prices, economic growth shouldn't be as strong as it is. There's a major disconnect there with the tariff question. I'm not an economist. I'm not going to speculate on what's going on. We know prices are high. I have a feeling that has to do with your unlimited quantitative easing of the COVID era. Interest rates should have went to 10% or 12% and been held there. They were not. So now we deal with entrenched inflation, and we're going to come into another dovish cycle, which is going to push prices higher, and everybody's got their fingers crossed that economic growth follows suit or at least outpaces inflation, and that way everybody gets a raise, and they say, well, I'm making $100 an hour now. That $25 steak's not that big of a deal. It's going to be interesting to see. I think the crash in consumer sentiment yesterday, consumer confidence, is a very telling thing. It doesn't matter if people are making more money. If prices are higher, they're still going to see them as a high price. I do. I look at the price of food. That's the number one thing I look at. And I look at that and I say, okay, what are we doing? That's a tough one to get over, especially when it's gone up as fast as it has in the last 5 years. I don't know where we're going. No idea. Pretty good idea that the dollar's going to lose, though. We'll see. We'll see how it all pans out. All right, everybody, I want to thank you for joining me. Thanks for everybody that commented in the live chats. I always enjoy the questions and the comments. Those are great. Feel free to check out a free account over at How to Trade. Send me a private message. I'll be sure to get back to you. And if you're watching us over on the Switch Markets YouTube channel, you can always like and subscribe, follow, set your notifications. We've got a couple of Switch Markets live trading webinars coming up. Those are going to be coming up. Let's see. I got How to Trade Gold and Silver tomorrow. We'll do a little high-impact scalping and see if we can make a few more dollars. Gold and silver are great target markets, so I'm always interested in trading those, but now even more so. Everybody's very interested. We'll talk spreads. We'll talk leverage, and then we'll also get into maybe how to execute a few trades, talk about some market drivers as well. As far as what we have on tap for you coming up Friday, PPI is the big release Friday. That will move the market, so we'll have that for you, at least trading the fallout on a Friday, probably a Friday strategy session. All right, everybody, fantastic stuff. Thank you for joining me today. Let me see. Eyes hazy. I'm not trading Fed days again. I swore them off, years ago. Traditionally, I found that my Thursday was always better than my Wednesday. So I would come in and I would lose money on a Fed day and then come back Thursday and make it all back. And I was like, why don't I just trade Thursday? The path of least resistance, guys. The path of least resistance. Gold nonstop. Adnan, gold is going to the moon, 53.58, and printing in the futures market. And right now we've got a spot trade right around 53.64. The spot trade is outpacing the futures contract. Aggressive to the top side, 3.5% gains. Silver's blowing up 115. You're going to 125 in silver. Really no question. The dollar's starting to give back early day gains. U.S. equities in a log jam. The VIX is off a little bit, but really a non-factor at this juncture. But you've got rotational trades setting up across your equities markets. This is a real ugly close. I would stay out of it. That's for sure. Let me see. It's going to be a big deal for kids when they turn adult. The inflation's going to be, it may be unbearable. I don't know. You're absolutely welcome, Eli. Jeanette, thanks, Shane. Always great live. I sure appreciate you showing up, Jeanette. I know it's tough. Your time zone makes joining these live very, very tough, but it's always good to see you in the live chat. All the best on your trading moving forward. One last comment, and then we're going to go ahead and sign off. Trading the news is not easy. I've tried it a few times. I didn't make the kind of returns I would have liked to have made. So what do? You just don't trade it. Very, very simple. There's an easy remedy for it. You just don't trade it. Tuku, good to see you. Always welcome. Ralph H., always a pleasure. All right, guys, I'm out. You guys have a fantastic trading day. Finish strong. Don't get hooked into, don't chase money on this last 24 minutes of the U.S. session. Come back tomorrow ready to go. I'm very confident about what we can do tomorrow. Later today, I don't see much of anything good developing here unless you got in on this gold move before the day started. And if you did, well done. Incredible runner. I'm watching it right now. I mean, wow. All right, everybody, have a fantastic trading session. Trade the action well, and we'll talk soon. See you.